Hey, before we get started, we have so many new listeners that may not know about the larger intentional success community. If you want to meet and network with a great bunch of folks that are open to sharing new ideas, and you want to learn more about how to apply my business model for live event production companies, then join us at Jumpstart Your Sales Engine in Atlanta, April 3rd and 4th. We're going to focus on the selling side of your business so you can grow, make more money, and have a lot more fun. Learn more at trstimson.com/jumpstart. Welcome to the Intentional Success Podcast, where we unpack the top strategies, explore business trends, and drill down into best practices to help your live events production business grow and scale on purpose. I'm your host, Tom Stimson. Back when I traveled like every week, I got very used to staying in fine hotels, flying first class, eating in great restaurants. When you choose to leverage your buying power by investing in key brands like one hotel brand, one airline, one car rental company, etc., you find yourself standing in line less, right? You become accustomed to more gracious service, and oddly, you become more tolerant of bad service. You're simply enjoying the journey more. You're arriving, you're more rested, you're less stressed because travel is hard. So when I had the means, and once I had the means, I made travel the easiest I could make it. It had a lot of value to me. But this made me very in tune with supply and demand of the travel industry, which oddly enough, we are a part of, right? And more importantly, about the brands within the travel industry. And I have often shared the story, my Marriott experience. I was a loyal Marriott brandee for many, many years. But around 2017 or so, the brand focus started to shift away, I felt, from people like me, the independent solo business travelers who are brand advocates. We're loyal to the brand. We're always going to stay there. We're eating the restaurants. But they wanted more conferences. And so I found myself visit after visit where instead of being upgraded, put at the concierge level and all the things I was used to, I was getting downgraded from my king bed preference, to 2 double beds next to an elevator. And after having that happen 3 times in a row, my top tier status had no value to me at all, right? Now, in that era, hotels were often very full. Travel was at its height. The supply-demand curve favored the most profitable guests, which made this treatment all the more puzzling because I paid top dollar. I just didn't buy in volume. So I switched back to Hilton. Yes, I was a Hilton person before. And I was immediately moved to the top tier, welcomed with open arms everywhere I went. And I actually saved money too because Marriott prices had gotten high. They commanded the top tier of the hotel brand market segment, and we're getting those prices as well. So marketplaces are funny things, right? We have to get inside the heads of both the buyers and the sellers and kind of carve out the subsets that fit together, right? Now, in 2022, in our live event world, we saw this excess of demand, all the revenge meetings that were going on. There was very limited supply. People were turning away business. This forced buyers to sample brands, many brands, before settling for really whoever was available at whatever price they were willing to quote, right? The same thing happened when they were looking at hotels. The hotels couldn't find enough workers. They had thousands of rooms available, but they didn't have enough staff to service them. So it was quite an interesting time in 2022. But in 23, the demand subsided. Supply caught up. People put their brains back into their head. But we had too many suppliers on our side, on the event technology side, who overcorrected their capacity. And at the same time, many buyers dramatically cut their budgets after 2022, saying, we extrapolated our national sales meeting budget out for the next 5 years and said, this is crazy out of control. We got to cut way back to make these numbers work. Both the suppliers and the demanders were responding to the marketplace. So the normalization of demand through 23 and now in 2024 means that we're seeing a balance between supply and demand that is shifting, right? It's just shifting ever so slightly. And I would say we are as close to equal in the macro sense of supply meeting demand, and we're kind of at an optimal price point. But in any given market, we will find excess capacity. And this actually encourages shoppers to shop around. So supply and demand never sits at that perfect price point for too long. Okay? There's always somebody who's going to have to upset this. We have excess demand or we have excess supply that is going to move those things around a little bit. Now, when that happens, where are those shoppers going to find you? Will they find you? Right? Now, simultaneously, in a market where we find isolated shortages of supply, we may also find excesses of supply. So shoppers will choose to look around. Maybe they'll stick with their current vendor at a premium price. I stuck with Marriott for many years, paid a higher price, right? Or maybe they'll go, well, wait a minute. Can I also stay at a nice hotel over here under a different brand and maybe get a better deal? And that's what we're starting to see right now. This is leading to some price shopping, or shall I say brand shopping, that we're misinterpreting as price shopping. So when supply and demand shift in either direction, customers move. They become opportunistic. When you don't understand this as a supplier, you might underreact or overreact to this trend. So in microeconomic terms, that is your business, okay, supply may exceed demand. You've got too much gear, too many people, which leads to price selling and worse. And the worst thing than price selling is adding overhead in an attempt to control costs and the timeline. A typical example I'm hearing a little too often right now is we need to add staff techs so we can handle last minute work and not be subjected to the high price demands of the freelance market. Well, the freelance market is the market, right? So if that is the price of the freelance market, are you really saving money by having staff techs in the macro, or are you only saving it on an individual job basis? It's a very dangerous game to play. And this is what concerns me a lot right now, probably most right now. The labor markets have settled down. Production companies are trying to hire techs to avoid the volatility of the freelance market. And this is a false economy. At a time when demand is flat but shifting and supply is rising, adding more supply just seems a little imprudent, don't you think? It's going to force broad price selling, which will drive prices down and create more customer churn, right? We don't like it when our customers look around unless they're looking away from our competitor and looking at us. So we're creating more opportunity for this, but we're doing it the wrong way by dropping our price. So for me, a more ideal outcome would be dynamic pricing, right? This is a critical piece of the supply-demand price puzzle that we've been fighting against for as long as I've been in this industry. Many of you shy away from this because you think your customers won't understand why they can't get the same price show after show. And the fact of the matter is their show keeps turning up in different months. There's different demand cycles going on year after year. We don't know what it's going to be like. So buyers need to see that price is tied to demand, just like anybody who books hotel rooms. Loyal customers will pay more for your brand, but how much more? And it depends on how well the competing brand plays in the marketplace and how good you are at maintaining the value of your brand to your customer. Now, what can you do about this? What can you do about this disturbing trend of lowering prices across the board to try and sell on price? Look, number one, keep your overhead low, right? You can still sell on price if needed. You know, if you've got to top off your calendar, if you've got a little cash flow crunch, you got a slow month, great. You can afford to sell at a lower price. Lower the room rate. There's no point letting assets sit idle while you have capacity. You can still make a profit. at a lower sale point. But likewise, you should be selling more aggressively if your cash flow is poor, because clearly you're not filling your rooms. There's probably a problem with your brand. There's probably a problem with your marketing and your sales. The short-term fix on that is get your prices down to where your value point is, get some customers back, figure out what's wrong, and then fix it. Reconcile value and price. Make sure your price point is tied to your availability, which is dynamic pricing. So the moral of all of this is to use dynamic pricing. With dynamic pricing, you can maintain your value proposition and still lower your price. The two things are not mutually exclusive. A Ritz-Carlton is still a nice hotel in the off-season when the rates are lower. I started staying at Waldorf Astoria's because Ritz-Carltons were getting all the business, and the Waldorf Astoria, which is just as nice, okay, we're selling at lower rates. I was getting wonderful suites for the same price as a king at a Ritz-Carlton. The Motel 6 rates actually go up when all the nicer chains are full. See, it's all relative, right? A rising tide lifts all boats, right? So when you are using price to win event business, be explicit in your scope of work. Set clear limits, inclusions and exclusions. Explain how changes, additions, and upgrades are going to be handled. You can still demonstrate tons of value, right? But it may not be the unlimited value of a higher fee event. If you pull again to the macro view, right? What does the buyer see? They see a marketplace full of brands. Some are clear, some are murky, and they see different price points. Where are they going to shop? Who are they going to choose? Who is going to win this battle over the customers that are choosing churn over stability? Are they looking for a better brand? Are they looking for a better price? Are they looking for better value? Value-based sellers that do good work at a competitive price will grab the most market share because that is what a majority of buyers want. If you look at the bell curve of buying habits, value-based buyers are 80% of the bell curve, right? They want, that's what most people want. Now, they may lean towards the lower price. They may lean towards the better brand. But at the end of the day, they are not at the extremes where they're always going to take the lowest price or they're always going to stay at the Marriott, right? So high-end sellers will have to work harder to push a higher-end price point, but probably what they'll have to do is narrow their target to the buyers that want to live in that space, which means they don't need to carry overhead to fill in between because there's no point in selling that extra work if they can't get their price point. But if they drop their prices to draw mid-market buyers up to their brand, they might be able to retain them during the busier time, and that's the gamble that they take. Do you want to add overhead based on that bet? Right? Now, as your business advisor, I don't recommend that you do that, right? There's an ideal balance point for your business model wherever you are in that bell curve. Low-end sellers will drop prices to pull mid-market buyers down to their brand, and maybe the buyer goes, hey, this brand is good enough. You know what? I've stayed at a lot of La Quintas. Some of them are pretty nice, right? So, and they're certainly a good value. The winner in all this is going to be the suppliers that keep their overhead down, price dynamically, and continually invest in their brand regardless of their market position. High-value suppliers focused on their brand, pricing dynamically, and continually investing in marketing and branding. That's where you're going to have the most impact. These are the people who are going to win. They're going to make the most money. They can realize the most growth. It is not what everybody wants. But if that's what you want, there's the formula. So in the end, it is not price that determines whether your business will make money. It is how you run your business that actually matters. So run your business the right way to achieve your goals. That's what I do. That's how I help my clients. I hope you'll reach out to me. I'd love to help you with those things. Now, this is a great time to plug you for Jumpstart Your Sales Engine, because if you want to learn more about dynamic pricing, how to price to win, how to price to retain, how to help develop the right type of customer. That's what we're going to talk about April 3rd and 4th in Atlanta. Visit my website, trstimson.com/jumpstart to learn more about it, or reach out to chat to me. We could talk about our intentional success clubs or strategy sessions that will help you and your team better understand where you fit into the marketplace and how to succeed. Thanks for listening. Keep watching those trends. I'll be back when I see more. If you want to find out more about today's episode, go to trstimson.com/podcast, where you'll find the show notes, related links, and tons of other valuable resources. If you haven't already subscribed to the Intentional Success Podcast, please do so, and I'd greatly appreciate if you would rate and review the show. Also, if you think you might be a good fit to work together or want more information about the Stimson Group, I'd love to hear from you. Visit trstimson.com for more information.